Okay, Jim, markets are digesting a two-day rally here, headed into Jobs Friday.
Right.
What kind are you expecting, how the market's going to play out?
The market seems to be saying that that there's some sort of resolution coming in Europe, and so therefore we can start looking at our own data again, which has been pretty good. Well, retail sales are very good. The hiring has been, it's not taking a step down. Back to school season turned out to be pretty strong. Here's my fear. I think that people don't understand the levels of crisis in Europe. What the people in Europe are talking about now is taking Lehman off the table. That does not mean that you're taking a Citigroup quasi-national nationalization off the table. Now, given the fact that Europe has come down quite a bit, you could argue that perhaps some of that is built in. My problem is it's built in when we're at Dow 10,000. When we go higher, it's not built in. So I'm suggesting to people that as much as I think that we're going to start focusing on U.S. data again, be aware that the solutions that are being talked about in Europe are to take Lehman off the table, not to take Citigroup, Washington Mutual off the table.
So I bet that's going to lead to some volatility. So then how does an investor kind of work that in?
Well, I mean, I think that when you're up a lot on a position, you take some profits, and then you position yourself for the next down leg. I mean, one of the things that I've been writing about and talking about is the notion that we're in a new world. I remember when I got in the business, the Dow had traded in this band of the hundreds to, say, 1,200. You know, when we got to 1,300, 1,400 in the Dow, people said, well, that's, you know, you just got to forget that. That's, you know, we're stuck in, we're never going to get past this range. And it just went and went, you know, obviously went to 14,000. It never looked back. I'm saying that the volatility, given the fact that retail has been leaving the market in droves, another good article in USA Today about that, given the fact that the rules are now favoring exotic trading instruments that clearly boost volatility, you have to have a trading style if you're going to be in the market, not just an investing style. Investing style, I've indicated, is dividends, okay, and reinvesting dividends, and that worked over the last 10 years. That fulfilled Professor Siegel's view about the long-term value of stocks if you reinvest in dividends only, otherwise it's not worked. And then you have to get comfortable with the trading vehicle so that you can triumph over these. Now, I'm using a rule: down 4% you buy, up 4% you sell. That's with the S&P. In other words, your trading vehicle. So right now, you just had up 4%. You should be taking your risk off right now. But I think that you need both an investing and a trading style here if you're going to be able to capitalize.
So then for the trading style, would you be then selling, say, industrials and energy cyclical, and then buying, you get a Colgate?
I think you want to find something that you like, so that if Greece fails, you have to accept the fact that you'll be buying that stock down 10%. I picked Disney last night just because what I'm trying to, you know, you could have picked McDonald's. It depends on whether you want to be more aggressive with an industrial or not. My problem with the industrials is that most retail investors will not know whether United Technologies is really falling apart or not if it goes down 15%. But you'll have great comfort with McDonald's. McDonald's at 78 is not going to bother anybody. McDonald's at 73 is not going to bother anybody. It's good yield. Disney at 25, 26, you're pretty confident about that. Caterpillar at 60, I don't know. I mean, like, you know, maybe people start worrying that the dividend's not safe. I think that's absurd. But I'm trying to get people, I want people to have a comfort level with the vehicle they're going to be trading here. And people say, well, listen, I don't want to trade or whatever. Well, then, you know, then fine. Just understand that you can just capitalize off the dividend issue. But what I'm trying to do is embrace the volatility, accept it, don't fight it, stop moaning about it, and come up with an instrument. Each person look into themselves. Maybe it is Apple, maybe it's Google. I don't like those for this example. I like a household name that you think about it like this. Would you be willing to give this stock to your kids? It's got to be that much of a rock bottom, I believe, situation, and tech does not usually fulfill that as a concept.
All right, so buy what you know, buy what you need, go to safety.
Yes, but then sell what you know as we get a rip up.
Great. All right, thanks, Jim.